2023 saw Matco's Diversified Income Fund deliver a strong 6% return, and it continues this positive trajectory in 2024, up 4.4% year to date. In the final quarter of 2024, the fixed income landscape will be influenced by these key factors: central bank rate cuts, recession concerns, credit market uncertainty, economic and inflation trends. First, central bank rate cuts. The global shift toward lower interest rates is a positive one for income investors. The US Federal Reserve's 50 basis point rate cut in September has set the tone, and additional rate cuts are expected in Q4. Similarly, other major central banks, including the European Central Bank and the Bank of Canada, are likely to continue reducing rates as inflation moderates and growth concerns rise. This easing of financial conditions will support income asset prices, particularly government bonds and high-quality corporate debt. Second, recession concerns. The yield curve, which had been inverted for much of 2023 and early 2024, has started to disinvert as short-term rates fall. Long-term rates falling alongside short-term rates is also a reflection of the market's expectations of slower growth and lower inflation in the coming quarters. Income assets perform well in such environments, as investors seek safety and yield. Now, thirdly, credit market uncertainty. While credit spreads have generally tightened in 2024, Q4 could see a bifurcation. Investment-grade bonds are expected to perform well as companies with strong balance sheets benefit from these falling rates. However, if economic conditions worsen, particularly in the face of US election uncertainty or geopolitical tensions, spreads may widen as investors demand greater compensation for risk. Active management and credit selection will be critical in any event. Economic and inflation trends. Inflation has been steadily moderating, allowing central banks to adopt a more dovish stance. Global economic growth has shown signs of vulnerability, particularly in Europe and China. In Q4, fixed income markets will likely be supported by the cooling inflationary environment, which should keep real yields attractive and bond markets stable. However, the risk to inflation is a rise in oil prices due to geopolitical disruption. Now, our outlook and strategy for the fourth quarter can be highlighted by the following. Duration positioning. As rate cuts are expected, longer duration bonds are likely to continue benefiting from declining yields. With a focus on longer duration assets in both Canada and the US, Matco's diversified income is poised to benefit from this. Quality focus and credit selection. Given the increased risk of economic slowdown, our focus remains on high-quality corporate bonds. These assets provide stability and reliable income. We continue to avoid those highly leveraged companies or those in sectors that might be vulnerable to economic downturns. Active management in credit markets, emphasizing financial health and cash flow resilience, helps mitigate the fund's exposure to adverse credit events or the widening of credit spreads themselves. The income market in Q4 2024 presents a favorable outlook, with rate cuts and easing financial conditions supporting bond prices and yields. However, the environment is not without its risks. Economic slowdown, geopolitical uncertainty, and potential volatility in credit markets will be monitored closely. A well-balanced fixed income strategy focused on duration, credit quality, and intentionally constructed yield curve exposure positions will position Matco's Diversified Income Fund to benefit from this evolving landscape.